Hi, everyone. Welcome back to Your Money Matters. I am your host, Angela Jarrell, and I am publisher of the Bauman Letter. Now, speaking of the Bauman Letter, Ted is releasing his next recommendation today, which means it's a great day to join. Please click the link above for more details on a special offer that was put together for you. Now, the word on everybody's mind, the big theme this year, consumer inflation. You have all this fiscal stimulus, people have money to spend and they're spending it. And it is driving up the cost of goods pretty much across the board. Now, I know that Clint and Ted, you guys have a very different take of what's going on. And if you're right, that means investors are looking to hedge against inflation and for profits in all of the wrong places. So Clint, what is your theory on all of this?
I think if you're focusing just on consumer inflation, you're skipping a step. You got to look at the source of where that's coming from and what implications that has for various companies in the market. So just to that point, I want to show one chart here that'll help illustrate where we're seeing the consumer pricing pressures, because this will once again show you kind of the source of where all this is coming from. So this is a chart that shows a global PMI for a couple different categories. So a PMI is just a purchasing managers index. There's JP Morgan put this one together. They'll go out and they'll survey manufacturing companies around the world, and based on their responses to the survey, they construct these charts. And they'll ask them things like, how's your current activity looking, or how your inventory is looking. But some of the things they ask about are lead times, if you're having trouble getting supplies, input prices. And so that's why I want to highlight on this chart here today. So the two lines I want to focus on, the blue line and the orange line. The blue line is that lead time. It's how hard it is to get deliveries, to get supplies. And this is now running at the highest level that you can see on this chart, going back to at least 1998. So that means manufacturing companies are having an extremely difficult time getting in supplies. Those delivery times keep getting pushed out. We keep hearing about all the supply chain disruptions. That speaks to that. And now then what that's causing the shortages is for input prices to rise. And so that's the orange line on here. The orange line is input prices as reported once again by these manufacturing firms. And those are running pretty much at the highest levels that you've seen, historically on this chart. So, so how is that flowing through then to consumer price inflation? Well, first it's showing up as producer price inflation, and just a couple charts here to illustrate that point. This is the pricing pressures that producers are facing. So here's the most recent look at the producer price inflation report. This is the year over year reading. It is over 8% now. That is the highest level in 11 years. And you just see the huge jump in producer price inflation on this chart. That's the year over year look. If you want to look at it month to month, here's the month over month change in producer prices. It's increased every month for 8 months in a row. And this is not just something that's facing US companies. This is something that is a global phenomenon. So here's a chart that shows not just the US producer inflation, but China, the black line on here as well. And you can just see this huge spike as we're having all these issues around supply chain disruptions and key component shortages. And so then tying that back to companies and stocks, like what does that mean if you're an investor right here? And it means companies are seeing a lot of pressure in terms of being able to deliver on the financials that they've been guiding to even just recently. And so you've had PPG, Sherwin-Williams, Toyota just today, Pulte Group Homes, all those companies have been out this week, just this week alone, announcing that they are going to fall short of their most recent guidance for the third quarter because of the input costs that they're facing, the pricing pressures that they're facing, and then also just the shortages of material, the shortage of labor, and just how all that's flowing through and impacting financial results across a variety of sectors.
All right, so Ted, now let's talk about the fun stuff. How do we play this?
Well, I think the first thing to do is to situate this within the context of the overall market. And the first thing to note is how overvalued it is. I mean, here's a chart that shows the cyclically adjusted PE ratio or CAPE ratio. We're at the second highest it's ever been. A lot of people say, like Professor Schiller himself, say, well, compared to bond yields, that's not such a big deal. That's true. But because bond yields have been so low for so long, you've had the TINA effect, which is there's no alternative to bonds. So people move into the stock market. And look what happened this year. Total inflows into the stock market just in this year so far, and we're only in September, are greater than the previous 2 decades cumulatively. That's just unbelievable. Now, that something that historically unique is unlikely to be sustained or to be repeated, let's hope. So what that means is that right now, the market is very sensitive to negative news. I mean, I've likened it to a mousetrap. People are looking at things and saying, you know, if this sector is starting to look shaky for any reason, then I'm going to move my money elsewhere. And I think that's exactly what we're seeing. Here's a chart of the S&P, which is the candlesticks, and the Dow, which is red. You're seeing that the S&P has been trading in a range since the end of August. We know that September is traditionally a weak month, but there's probably more to it than that. And that's partly, I think, because of the Dow. The Dow is down significantly this month, and that's because I think of what Clint was saying. He's, you know, the Dow is full of companies that make real stuff in the real world, and if they're having supply issues, like PPG or the housing companies or you know, Toyota or anybody else, then these companies, you know, then people are going to sell those stocks because they know that their margins are going to squeeze because they're having supply issues. So to me, what we're seeing is investors moving towards stocks or companies that produce primarily intangibles, companies that don't have these supply chain pressures. And a lot of it has to do with technology, because, you know, bits and bytes, ones and zeros don't cost anything. Your marginal cost of sales if you make software is practically nil. So here's 3 ETFs that show just an amazing pattern. The first one is the Global X Cybersecurity ETF, or BUG. Starting right around the end of the 3rd week of August, you see just a big jump up in, you know, in that particular ETF, which is reflected, of course, by its holdings, compared to the S&P, which has just managed to eke out a little bit more than 1% over the same time frame. The next ETF is Global X Robotics Artificial Intelligence, which is BOTZ, B-O-T-Z. Again, up nearly 12% since the end of the 3rd week of August, and, you know, just blowing the market away in that same period. Finally, you have the S&P Biotech SPDR, which is XBI. It's up a little bit less, but I think, you know, it's a much broader sector, and it does include some companies that could have supply chain issues. But bottom line is that all 3 of these ETFs are ETFs that reflect companies that smart investors know will not be as affected by supply chain issues, and so therefore will not likely to see compression on their margins. Because remember, when companies face supply chain and producer price inflation, the last thing they want to do is to raise their prices, because that puts pressure on their consumers. They want to try to absorb those costs as long as they can, and you know, that's one of the reasons why investors will say, okay, well, we need to cut back on our shares. Our share ownership there, because that means that our yields from those are going to fall because they can't raise their prices for competitive reasons. All these other companies, they can. Now, there's one other factor. All of these companies, most of them, you know, in those 3 sectors, maybe not all in the biotech, but they're considered growth companies, a lot of them, especially in robotics and AI and in cybersecurity. And so therefore, low interest rates are good for them. So that's part of it. But I think the really big thing is that investors recognize that the yields on these companies, the cash flow yields, all the yields that count, will not be compressed by supply side stuff. So they're shifting to those. Now, as I said in my video, not last Friday, but 2 weeks ago, growth is great, but you've got to be selective. You want strong tailwinds. Now, I see strong tailwinds across all these sectors, but I especially like biotech, especially if you're not a trader, if you're an investor who wants to, you know, basically buy something and hold on for it for a long time. Biotech is where you want to be. And that's because we have tailwinds, really strong sector tailwinds that are recession proof, you know, in that sector. We have an aging population in the developed world. We have populations in the developing world that are beginning to develop chronic diseases that require long term treatments. And we are also starting to see a revolution through the use of things like mRNA vaccines. And that now that we've opened, I would say floodgates, but some people might even be tempted to say Pandora's box when it comes to these genetic level treatments of viruses, I think we're going to see an explosion of those kind of treatments going forward. And that is going to be powerfully bullish for the biotech sector over the next decade or so.
And again, another great reason to join the Bauman Letter, because as you explained, you had a biotech play last month. And that was before we got this great news that we were just talking about, that the AIDS vaccine is headed to clinical trials with that mRNA technology that you wrote about last month. So great call on that, Ted.
That's right. And the other thing, of course, is that now that we are seeing this kind of technology in wide use, we're going to start seeing it used as an antiviral. So even if you're infected with a disease, they can give you something, like people talk about Tamiflu for the flu. We'll start seeing that stuff, maybe even for COVID. That's the kind of thing that is going to really just create opportunities. The great thing about biotech is that one day there's no market, the next day the whole world wants your drug. And if you get that right, you can make a lot of money.
And we've got another great pick this month that's right up that alley. So make sure that you subscribe, click the link above. Ted and Clint, thank you so much. I'll speak with you next week.
Thank you.